All right, so while Barry gets set up, here's what my little bit of advice to everyone, because I have a preview of what's coming, but I'm sure it'll be different because things have changed already in the last month. Don't take notes. Really pay attention to what he's saying, because if you're taking notes, you'll miss something else. You'll miss another nugget. This is all being recorded. I'll have it on YouTube by tomorrow, so you do not need to take notes today. I'm excited. This blew my mind last time. So I hope you guys get a lot of good information. I guarantee you'll close more transactions from it, and it just gives you perfect perspective to what's come. So don't take notes.
I'm with you, bro.
Oh, cool. I lost you. I can't see you anymore. There you
No,
go.
it's okay. I just didn't know if you were going to do any intro or anything like
Yeah,
that.
I'm going to do it now. I'm going to do it now. I thought I was on pause with you. So
No, I'm good.
all right, everyone. So if you don't know Barry, I'm sure a lot of you already do. Barry is a legend in real estate. I would call him the #1 economist in real estate. You'll see those two little crystal balls right behind him that he got from Zillow. Only guy that's won those, won twice. And that's out of the top 100 real estate economists in the country. So if anyone knows what's coming, it's Barry. And I'm fortunate that Barry took me under his wing, 10 years ago now. All the videos I do are because he forced me into it back in 2010. So I owe so much to him, and I'm so grateful that you're doing this. Thank you.
Thank you, buddy. You're amazing. You're doing such wonderful things. So it's a privilege to be here with you.
Thank you. So I'm just gonna, last time I had like this whole podcast style thing in my mind, and Barry just ran with it, and it was incredible. So I'm gonna let you do your thing.
So what are some of the questions that you folks are most concerned with right now? Because a lot of people are talking about the election. A lot of people are talking about what the impact would be, where are rates going. There's a lot of forecasts from people saying, the housing market's going to have difficulty next year. People like Diana Olick, like Adam Data, like the Crash Brothers, who are forecasting a 60% drop in real estate prices. Adam Data saying that foreclosures are going to get out of whack. Diana Olick saying real estate values are going to drop. The Mortgage Bankers Association says interest rates are going to skyrocket next year. So there's a lot of forecasts out there. There's a lot from the election. So I'm happy to say that I disagree with all those forecasts, but we can dive into any of those, Sean. So you tell me where you want me to go first, and that's what we'll do.
So I'll tell you what, the reason I asked Barry last time was, it was more a favor. And I said, Barry, this is what I think is going to happen. I think the government subsidies are going to end as being good Americans. We're spending money that's not ours. We're not paying our mortgage. We're not paying our student loans. We're not paying our car loans because the government said we don't have to. And when that all ends, people are going to find themselves in a tough spot. I thought that would create forced sales, not necessarily foreclosures because everyone has equity, but forced sales, and maybe we'd get more inventory. And that was what I asked for. And he had just everything we went through last time was amazing, right? Just talking about how the market probably, why you disagree with what those other economists are saying, I think is great. And it would be great to touch on rates, because if the vaccine comes out, we got a little hint on Monday of the hope, but then we were already kind of moved in the other direction. So I think both of those things would be great. I think.
Okay, so
yeah.
Let's talk about some of the things out there. So let's start with some of the more current matters. That's the vaccine, as you mentioned, and the election. So right now, it appears anytime you talk about anything political, you got to be really sensitive and really careful. So please understand, I'm just going to state what's out there. It appears that the presumed winner is Joe Biden, and it appears that the House will remain in Democratic control. And it also appears, I am not making these calls, I don't know, I'm just saying what it appears like is that the Senate will remain under control of the GOP. And because of that, the markets are responding in a favorable way. They do like the fact that the GOP has the Senate and the House it belongs to the Democrats. So some of the tax policies that were thought that could come into play appear not to be as strong a chance of them happening. So the markets, I'm not saying it's my opinion, the markets are saying that they like that because the market does not want to see higher taxes. With respect to one of the policies that are out there that affects us directly in housing, I'll give you my opinion on that. And that is what looks like on the surface that could be a good thing, a $15,000 tax credit. And you'd say, oh, wow, that's a great thing, right? The problem that I see with this is that it looks a lot like, Sean, what we remember back in 2009 and 2010, where it looked like a good idea to give a tax credit to purchase a home. And at that time, it was $8,000. but the housing market was not doing well and was trying to stimulate a housing market which wasn't very strong at the time. So you took a period of time in 2010 where people would have, over the course of 2010, would have purchased homes, and it shoved everybody in before the deadline of April to buy a home. What that did was it drove prices higher, artificially higher, because everybody was trying to cram it in. And what wound up happening was, after the tax credit expired, nobody was there to buy a home. All the people that would have bought a home weren't there, and home prices declined, and they declined much greater than the value that they received in tax credits. So people wound up getting really badly hurt. Now, over many years, it's come back, and that's okay, but it was a very bad idea to do this tax credit. We know that it's a bad idea. We have history. I want to do it again. Usually when you have a very bad idea, you try not to do it again. But the reason why I think it's much worse this time is because there's already no inventory. So what you're going to do is you're going to take already no inventory, already houses being multiple offered, and jack them up even further. And the poor people who are going to wind up buying, thinking they're going to get tax credit, are going to be left holding the bag because they're going to wind up paying much more for the house than they should. And I think that that's something that those of us in real estate and mortgage, we should think about and actually hope, believe it or not, that that doesn't happen. Now, this is not just my opinion. Lawrence Yun, who's the chief economist for the National Association of Realtors, he almost exactly took what I've been saying in my updates and almost said what I said to you just now, word for word, and repeated my words. So even if the National Association of Realtors, which is like, give us any benefit we can, is being cautious about this, is because Lawrence Yun is smart, and he knows what happened 10 years ago, and he knows it was a disaster 10 years ago. And I am fearful, folks, that might be a disaster now. Now, interest rates. Everybody's saying rates are going to go up. The problem with that is that they just don't understand what drives interest rates. And what drives interest rates is inflation. Inflation means that prices go up over time. And that's because inflation is the enemy of bonds. So if you were holding a mortgage, in other words, let's say you lent me money and I was paying you $2,000 a month. Well, you take that $2,000 a month and you have a shopping list of goods and services that you use that $2,000 a month to buy. You get my check, you buy that stuff. Next month, same thing. Next month, same thing. But over time, you can't buy everything on the list. You know why? Because over time, inflation makes prices go up. So the value of that mortgage payment that you're receiving erodes over time. Now, you accept that and you sign up for that. But if inflation were to start creeping up higher, well, then your erosion happens more rapidly, and the value of what it is isn't as strong. You can't do anything about the loan you gave me. I'm gone, right? But you're in the business of lending money. So the very next loan that you do, if you know that inflation's rising or about to rise, the only way you can protect yourself from that erosion is to start from a higher perch so that you could offset the effects of more rapid erosion due to higher inflation. And the only way you get to a higher perch is by charging a higher rate. And that's why interest rates are governed by inflation. So if growth is high and things are good, think about inflation that you see in real estate, right? When lots of people want to buy homes and there's not a lot of homes, what happens to prices? It goes up, you get real estate inflation. And it's like that when the economy is doing very well, you get inflation. However, when you see slow growth, inflation's kept down. When you get great technological advances, that makes things faster and cheaper. Inflation's kept down. Slow growth happens in everywhere in history, in every place in the world, Japan, China, UK, Eurozone, United States, anytime debt rises. Why? And this is what, like the MBA, they don't understand this stuff, and it's complicated. I'll try and make it simple. If a family has a lot of debt and their monthly payments, because they have to service that debt, you got to make monthly payments, is so much that they don't have a lot of extra money to stimulate things and create activity, that's not going to allow a lot of room for growth. When it happens to a government, and the government is so far in debt that they have to have all of this debt that they're servicing. We're not printing money, we're borrowing money. And now we have to pay it back with monthly payments of interest. That interest payment takes away from dollars we could use to generate and spur economic activity and growth. So we get into this low growth, slow growth phase, which slows economic activity, which slows inflation, which pressures interest rates lower. So I believe that you'll probably see a very good period of time for interest rates next year. But here's the caveat. If we get into a position where we continue to see demand high, like people have started to adapt since Labor Day. Now, I know we've gotten a rise in COVID cases, so it's started to slow down again. But if people feel more comfortable, however, we don't get the workforce back until there's a vaccine, you might have a gap where you got more demand than supply, so prices could rise. And that's why I've seen interest rates go up a little bit recently. But if we get to a point where some of these good news on vaccines, now we're going to expect Moderna's news next week. We got Pfizer's news showing that this vaccine that Pfizer has and the one I think Moderna has, and remember there's another, besides the 229 other companies that are in the process, that if we get a good selection of vaccines, if we get good therapeutics like this Eli Lilly therapeutic, which is like a cocktail, that's the one Chris Christie took, Donald Trump took, and it seems to be very, very beneficial, along with things like ultraviolet light, UVC, far UVC, and there was a spectrum of 205 to 222, not harmful to humans in that spectrum, but it kills virus and bacteria. It's just very expensive now. The Miami Dolphins put it in their locker room, but they can afford to spend $300,000 for the locker room. I can't afford that for my house. Probably many of us can't, right? For my room. So imagine when they become cheap, like flat screen TVs went from $25,000 to $300. Eventually, when there's LEDs in it, becomes cheap. Then what'll happen is you'll have it in your office, you'll have it in your home, you'll have it in the theater, you'll have it in a restaurant, and this will be great, but it'll take a little time. So between now and then, we could see a little inflation. But when we reach a point, and I think God willing, it'll happen next year, when we could say, okay, the masks, they could come off now, we could hug each other, we could do this stuff. When that happens, then people will be back to work, demand and supply will meet, and we'll resume where we were in 2019, and rates will be pressured lower. Now, remember, when I talk about high debt, in 2019, our debt was a very high level of $22 trillion. Now, just to put it in perspective for you for a minute, this will be fun. If I said to you, here's your job, you got to spend $1 million a day. Now, Sean, even for guys like me and you, spending $1 million a day, every day, 7 days a week, that's hard work, okay? But spending $1 million a day, how many days would you have to spend $1 million a day to get to $1 trillion? Does anybody want to kind of take a guess and put it in the chat window? How long would that take? Anybody want to do that?
I pride myself in math, but I can't figure that out off the top
All
of my
right.
head.
So anybody want to put a guess in the chat window? It'd be fun to hear from you. Don't be afraid. There's no bad answers there. I'll give you another few seconds. Okay, 30 years. Good guess. Good guess. I guess it would be surprising to most of us if we would know what the answer is. The answer is 2,700 years. 2,700 years. You would have had to have started in 700 BC and $1 trillion at $1 million a day to get there today. Now, the reason why I bring this up is because we become a little bit immune to the word trillion because you hear it a lot, but man, $1 trillion's a lot. And 22 trillion, enormous amount of money. But now it's 27 trillion because we had to have done all this stuff due to COVID, and another stimulus package would push it to 28 or 29 trillion. So that heavy debt and the debt service, we know historically creates slow growth. We know that pressures inflation, and we know that pressures rates. So when we take the masks off, we resume the trend, and I think we will see very good interest rate environment. As far as real estate goes, I got some slides I could share with you, Sean, if you want to.
Yeah, that'd be great. Because that's, I think for us, like what I noticed in the Bay Area, California as a whole really now is prices are skyrocketing all over the Bay Area. I was doing one cousin's loan. His house appraised for $1,260,000. A month later, his cousin bought a house 3 doors down, and he bought for $1,385,000. So $120,000 in a month in equity. So for me, that's where I was like, it doesn't seem sustainable. This has to end. When the government subsidies end, there has to be more inventory because people just can't afford it anymore because they have to start paying. And that's, what you showed last time was incredible. Like just things that.
So let's take a look at a few of those, Sean. So Sean, if you don't mind, do me a favor. Next to where it says participants on the screen, just to the left of that, you'll see a shield, and just allow screen sharing.
Participants.
Hover your mouse over the screen, you'll see where it says participants. Then to the left of that, you'll see a shield.
Let's see here. I'm going to make you host.
Okay, that's fine.
Faster.
There you go. All right. So you can see my screen. So one of the things that we heard the Fed say was the Fed said that we're going to keep rates low for 3 years. And for many people, what they hear is that mortgage rates will remain low for 3 years. That's not the case. The red line's mortgage rates, the blue line's the Fed funds rate. You can see they move in opposite directions. Now, this is a 50-year look, but you could see that sometimes they move similarly, sometimes they move in opposite directions. But if you want a little history for when the Fed was at zero, look at 2009 to 2016. For the 7-year period, the Fed kept rates right here at zero. What happened to mortgage rates? Well, here they went from 4% to 5 1/8 while the Fed was at zero. Here they went from 3.5 to 4 7/8 while the Fed was at zero. So our clients can't get lulled into a false sense of security in thinking that rates will always be at zero or low, that even if the Fed's there, there's not an attachment to the Fed funds rate by mortgage rates. They're two separate instruments. And in all of 2019, and Sean, you remember this, people thought I was crazy because I forecasted that the 10-year Treasury, which was at 3%, I said it's going to 1. Nobody believed me. Everybody thought it was going to 5. All the experts supposedly said it was going to 5. I said it's going to 1. And pre-COVID in January of this year, it did go to 1. Then when it went to 1, they all said, okay, you got that right. Where's it going now? And I said, they're going to a half. And on CNBC and on Fox, they all thought I was nuts. They all wanted to debate me. But it didn't take long after I made this prediction. 3 days later, it went to actually 0.4. So all the same metrics that I've been using with debt and what's happening are what I'm telling you now and why I'm thinking that the rate environment will be good. As far as real estate goes, people are waiting longer to get married. It used to be 20 years old, people used to get married. Today, it's 30. Why is that important? Because if you believe that oftentimes people get married and then what happens is that they have kids after they get married. Well, having kids is the single biggest driver of home ownership. If you're a millennial, ages 30 to 39 with no kids, home ownership rate 38%. At least one kid, 80%. So it drives home ownership. And if you go to Google and you type in the Google Trends section and you say, okay, let's type in a search term. This is a great thing for you guys to do anyway. You can put in any search term to see what's hot out there. Type in baby registry and you'll see it's at its most interested point, the highest trend in the history of Google, 17 years. Who knows? Maybe people got busy during COVID, but for whatever reason, people are thinking about baby registry, which means they're thinking about having kids, which means that the home ownership demand will be greater. And it's all coming from people under 35 years old. This is the hot spot right now in the economy. I'm sorry, in the housing market. And if you're listening to this and you're in real estate, you might be thinking, how do I market to these people? Well, it's a good idea to market to somebody under 35 because in a 12-year period, that person under 35 will move 4 times. If they're over 50, that same person will move once in a 12-year period. Now, you want to clearly market to them, but don't miss out on this. And the reason I say you miss out on this is because so many of you are not doing social media marketing, which you should. And you should talk to Sean because he'll help you. And if you are doing social media marketing, people say, well, yeah, I'm on social media. I'm on Facebook. Facebook's great. But people under 35, they don't go to Facebook. They go to Instagram. None of these guys have reading glasses. They all look like Sean, okay? They don't look like me with my reading glasses. So when we take a look at something like this, make sure that you're marketing to Instagram or you talk to Sean who can help you market on Instagram because that is really the secret to these younger individuals. Now, when you take a look at births each year, this tells you how many million people were born each year. Your boomers, your Gen Xers, your millennials are all here. According to Zillow, the median age of a first-time homebuyer is 33 years old, which means if you do the quick math, that means they were born in 1987 or 86, right here. Now, I want you to be a critical thinker here. And I want you to say to yourself, okay, what does the future look like? So if we know that right here, these births represent today's first-time homebuyers, you see something happening over the next 5 years? Well, yeah, up in births, which means there is going to be a huge spike, a spike like we haven't seen in 15, 20 years in first-time homebuyers, where you're going to see people go way up in their appetite to purchase a home. Does that, everybody see that? So when you see this big move higher in births, that means over the next 4 years, first-time home buyers will be in high demand. Now, I use this exact same thing to forecast the housing bubble. Why? Because the housing bubble started in 2006. So the people that were buying homes for first-time home buyers in 2006, when were they born? 33 years before that, or 1973, right here. This is 1973. Notice the huge drop. Just like there's going to be a huge spike, there was a huge drop in birth rates. Does anybody want to take a guess? No bad answers here. Why do you think there was a huge drop in birth rates? Anybody want to guess on that one? Come on, put it in there. It's fun.
I'm not guessing, you guys, because I know the answer. So,
All right, so here's a good guess. Vietnam. Very, very good guess. Wasn't the primary reason. Some people say oil prices. Some people say recession. All good reasons. Some people say birth control. No, that's here. Birth control, 1960, and you can see what happened to birth rates after birth control. Right after the pill, this is what happened. But this drop is because in January of 1973, by the way, also good guess for gas tax, long lines. Yes, true. But the real reason was Roe v. Wade. January 1973, the Supreme Court ruled to make abortion legal, and birth rates plummeted. They stayed low and then slowly started to go up. And 33 years after abortion became legal, you had the housing bubble. It's exactly 33 years later. Now, if you want to take a look at this in action, watch this. You see these blue bars here? These are households being formed. In other words, somebody leaves mom and dad and they go out and they turn on the electricity on their own for their own place. Now, the gold bars, that's builders putting up homes. And it was kind of close, kind of close, kind of close. But then in 2006, what happened? 33 years after abortion was legal, birth rates had dropped. So 33 years later, household formations dropped. And when household formations dropped, builders did not pay attention to this. Now, we forecasted and we predicted it because we were looking at this, but builders didn't. And builders put up a lot more homes during this period of time than households are being formed. And when you have a lot more supply than the demand, you have a housing bubble. So this is what caused it. But then you notice they flattened out. So they dropped, flattened out, and then started going up. And if you want to know why there is no inventory, look no further than this. So many more families forming households, but builders not keeping up, which every year inventory gets depleted. And now you're in a position where you got multiple offers and bidding wars because there's not enough homes to meet the demand. Now, by the way, look at this pattern. Big drop down, 33 years later after abortion, flat, and then starts going up. Here it is. Here's the births from 33 years ago. Big drop down, flat, starts going up. It's a hand in glove. It's an exact duplicate. Why? Because those people were born and they're coming. Now, when you take a look at what's going to happen in the future, look at this. Spike up, which means this will spike up over the next 4 to 5 years. And builders are not keeping up. Look, builders for the last 10 years were not even keeping up, but COVID caused this huge decline. So it took an already tight level of inventory and builders not keeping up. And now builders really behind the 8 ball. So you have nowhere else to go but up in prices. And now on top of it, you have record low vacancy. Why is vacancy important? Well, because if I got a property and I'm paying $5,000 a month for it, I might be inclined, if it's empty, to dump it and say, look, I'll take a $10,000 hit on it so I don't carry it for 2 more months. Well, with no vacancy, I'm not inclined to drop prices. Team, anybody who's saying that there's going to be a housing bubble is just ridiculous. Look at inventory, record low. You want to see what a housing bubble looks like? Here. Or for those of us that remember in the mid 80s to late 80s, here. But this is not housing bubble territory. This is home prices are going to go up and by a lot. And here's the other thing that people don't get. Affordability. Like, well, affordability, homes are too expensive. Well, incomes are going up. You know what incomes are going up? Don't go by hourly earnings, which are 4%, because you can make more or less per hour. Go by weekly earnings, because that's what you take home. And that's at 5.5%. So we're getting a big jump in income. However, when you take a look at affordability, it's in the top 7 of all time most affordable markets, even with home prices going up. And this is the thing that people don't understand about affordability. I'm going to give you a great example, which will give you such a huge benefit compared to what the media understands and compared to what the other people think about. This is something you have to explain to your customers. when they say, well, homes are not going to be affordable, imagine last year, if somebody listened to Diana Olick or the Crash Brothers or Adam Data or so many of the other people who said, rent, don't own, real estate's no good. Everybody's been saying that forever, right? Well, if last year, to use a simple example, you could have bought a home and your payment for principal and interest was $1,000 a year ago if you would have bought it, but you chose not to do it, your income then would have been roughly, according to what the averages are from Fannie Mae and Freddie Mac, $5,000 a month in income for a $1,000 a month principal and interest payment. Now, you didn't buy the house last year. So now this year, prices went up 5%. So if interest rates stayed the same, to buy a similar home or the same home a year later, you got to pay 5% more, which means the cost monthly would go up 5%. So instead of $1,000 a month, this year it cost you $1,050. So that means if you want to keep up with it and offset the cost, your income had to go up $50 a month. So your income had to go from $5,000 to $5,050. That will offset the $50 increase in real estate value. How much percentage does your income have to go up? Does it have to go up 5%? No, 1%. So a 1% rise in income matches a 5% rise in real estate prices. And this is what the media doesn't understand. So with incomes going up over 5% per year on a weekly basis, which is the right way to look at it, real estate could go up 15%, could go up 20%, it could go up 25%. And if interest rates stay around the same level, your home becomes more affordable, not less affordable. That's very important for you to understand. The other thing people say, oh, what about the foreclosures? It's not. First of all, foreclosures, forbearance, people have equity today. So people will find a way to preserve that equity. This is not 2009, where 26% of homes had the mortgage at a higher value than the value of the home. They were upside down. Today, 87% of people have at least 20% equity in the home. 95% have at least 10% equity in the home. There's a huge equity cushion. And because of this, ladies and gentlemen, when you think of the average time, according to the National Association of Realtors, it's 21 days listing to contract. But that includes, as you know, so many people put their homes up for very high, unrealistic prices. Remove that. And let me ask you this. If somebody puts their home on the market today for a pretty good price, how quick can that go? A week, 10 days, 3 days, 1 day? You know better than me. So people, if they get into trouble, they'll sell the home to preserve all this equity. Now, if we take a look at housing, there's 127 million households, 41 million are rented, 86 million are owned. 34% of those, or 29 million, are owned free and clear. So that's a lot of homes free and clear. Of the ones with a mortgage, do you know the average loan to value is 53% and about $180,000 in equity in the home? So of course they're going to preserve that. Our forecast for this year, at the beginning of the year, and Sean, you know this, was between 5.5% and 6% appreciation. Well, guess where we are right now? 5.7%, right in the sweet spot. Now, by the end of the year, we might be wrong because it might be above our 6% range there. So we could be above that to a little over 6% by the end of the year. But we're pretty close. We're forecasting, again, somewhere in the neighborhood of 5.5% to 6% appreciation again in the year ahead. Now, today, in order to purchase a home, you almost have to win the home, right? It's like you got multiple offers. Or what if there's a cash offer on the other end? How do you compete with that? Well, you compete with a cash offer by offering more. You compete with multiple offers and win by bidding more. But for all you wonderful people that are in real estate listening to this, I don't envy how you can get somebody to bid more than asking price. Look, for me, I don't even want to pay full price for something. So now you're going to tell me not only do I got to pay full price, I got to pay more than what the seller is asking for? That's a tall order for many people. So let's just use a quick real example. This property in Walnut Creek, the current asking price is $650. Now, when we do an automated valuation model with 96% accuracy, the value is $632. They've got it on the market for $650. Now you got a cash offer at $640. You got a bid at $650, a bid at $655. In order for your client to win, they got to come at $660. So that's more than the $650. That's more than what the AVM is worth. How do I get them to do it? Well, here's what my client wants to know. Here's what your client wants to know. If I'm going to pay $660 for this home, when will the appraised value or when will the AVM be greater than 660? When will I get my money back? And that's when you use this amazing tool that Sean has access to that he can help you with, which will tell you when the break even is. And in this actual real life case, it's April of 2021. Now, why is that important? Because if I put a contract in November, when are you closing, ladies and gentlemen? You're closing in January. And if you're closing in January, when's your first mortgage payment? In March. So by the time I make my first mortgage payment, 30 days later, the home value is already over 660. That's a lot easier to talk the customer into bidding that. Now, if you look at over the next 5 years, the forecasted appreciation on this home is plus $240,000. This really helps you with your job of making it easier.
Can I interrupt real quick on that? So Barry and I did this like 2 months ago, and I'm embarrassed to say I didn't know that tool existed in his service. I have used it so many times ever since then. For just, you guys are showing houses to people who will just want to make offers randomly, and we're trying to say, oh, I don't know, this person might offer here, I think it'll go for that. And there's no data behind it. And being in Silicon Valley, like a lot of us are, the more data you have, the better. And using that tool, I have one example where the realtor didn't give any guidance. The buyers were making below ask offers on multiple offer properties. I was tired of making pre-approval letters. So I overstepped my bounds. I said, look, you guys, I can use this tool and look what you can do. And now they called me yesterday, like, we are making more, we haven't got accepted yet, but they're making better decisions because of that tool. So thank you, Barry, for that, because I did not know.
It's my pleasure. And remember, there's nothing in the history of the mortgage business or real estate industry that has ever been like this. This is the only thing of its kind, and Sean can help you with it. Here's the other thing Sean can help you with: the estimate. So we have the MB estimate, which is like Zillow's estimate. Sean could do these for you, as many as you want, whenever you want. He can even co-brand a report. Hey, just start typing in an address. Boom, pop it in, and then it'll give you an entire breakdown and report, not only of the subject property, how many bedrooms, baths, square foot, but everything in the neighborhood. And you could go out even further if you want to get more homes. And then you could see the level of confidence. You could see what the range is, what the value is. You could see all the history. You could adjust the value if they put in something or there's something there that's really great about the property. And you could see it on a map. There's all of this data that's at your fingertips. And Sean could do this and create it in a report that's co-branded from you at no cost. Now, if you want to take this further, it's important because you don't want people to go to Zillow to get this estimate, because otherwise they're going to be pixeled. What does pixeled mean? It means that just like you've all been pixeled. Have you ever gone to shop for household goods, a pair of shoes, a car, anything you've gone to shop for? And then you go on Facebook, you go on another site, and you see there's ads for that exact. How did they know? Because you've been pixeled. And if you go to Zillow for their Zestimate, you're going to get pixeled, and that customer of yours is going to get bombarded with Zillow's mortgage and real estate offers to try and steal that customer from you. So don't allow them to do it. Now, what Sean's got here is a way for you to get those values from him. But if you want to go a step further, here's what Sean could do for you. Sean can now take this and put it on your website. So he could co-brand with you. So you will have your own AVM. Nobody will have this on your website. And by doing it that way, it's very easy. And where you could drive traffic to yours and your website, and it'll look something like this, where you could put the buy versus rent, real estate report card, and the estimated home value, where people will then be able to access your website, drive leads to you, drive traffic to you. And then what they will do is they will be able to see what the value of any home that they want is instantaneously, just like I did so seamlessly right there.
And I'm not keeping up. I didn't know that existed either.
That's just been released.
Okay, good.
It's just been released. And team, Sean, I just want to show you one last thing.
No, thank you.
And that is, here, I'll come off of this too, and I'll stop the sharing. If you haven't done so already, please get my book, Money in the Streets. It hit #1 on Amazon's new release bestsellers. So I can say that we've got a #1 bestseller there. It'll help you through a tough time, which we all go through. It'll help you maximize a good time, which I hope you're going through. But it'll also help you see opportunities that everybody else is missing. And you know what was really great, Sean, is that if you go to Tony Robbins' Facebook page, he doesn't do this, but go to Tony Robbins' Facebook page. If you do that, he did a whole thing about the book. We put a video on there. He doesn't do this stuff. He's such a believer in the book. He put a whole video about money in the streets because it's something that he thinks that you must read.
No, I love it. Yeah, let's do this. The first 10 people to email me, I'll send you a copy of Barry's book.
Wow.
Done. So let's get 10 of those out there now. And then so really everyone, just the birth rate thing that blew my mind last time. But just you put all these other data points aside, and just population is gonna win. And you look at builders. There's no land left where we live, so there's nowhere to build anyways. So when you're talking to your clients and they think they're gonna wait for prices to drop, this will help. And I have a 1-minute clip of Barry that we did from the last one. I took these 2 little segments and it perfectly speaks to that in 1 minute that you can send to them. But if you take nothing else away, that's everything. We all think our markets are unique, right? Yeah, but my market's different. But Barry has a tool that shows bid over ask, and he helps lenders nationally. So we're not that special. I was just in Texas on a bass fishing boat, and the guide's telling me how his neighbor's house just sold multiple offers and it wasn't even on the market for a day. And this is in rural Texas. So we're not that special. So just keep in mind, it's happening everywhere. It's not just us. Our price point just happens to be a lot higher. But Barry, this has been awesome. If anyone has questions, please ask. What will the effect of Prop 19 be on the market?
I'm not going to go into the local stuff because that's not really my area of expertise.
So I can answer that one just kind of briefly. So Prop 19 basically gives people of retirement age the ability to transfer their tax base. I think that helps, but Chris Trapani actually spoke to why there's not more inventory in Silicon Valley, and it's because people have so much equity. If they leave, there's capital gains tax, so they're just waiting until somebody passes away. He spoke at the Saratoga meeting in 2017, I think is when he gave me that data point. So I don't know how much Prop 19 changes things specific to our area, because you still have huge capital gains if you've lived in your house in Palo Alto for 30 years.
All right, so I want to be respectful of time. I knew we were supposed to.
If there's no other question, if no one has questions, we can wrap up. And Barry, thank you again so much for doing this. I hope everybody got something out of it. If you have questions for me, my email's right on the screen. Just let me know how I can help. But Barry, it's so good to see you. Thank you so much for doing this. I really appreciate it.
Thanks, everybody.
All right, brother. See you later.
Thank you. Bye. Thanks for the nice comments, everybody. Thank you. Bye.
All right. Bye, everyone.